In the first module, I said that a good trader will treat their trading like a business. Now, there are two elements to a business: revenue and cost. Most of the time, traders are only concerned with the former, i.e. the trading profits. Indeed, most of our courses are about profits, but in this instance, we are going to spend a lesson looking at the costs. All good businesses assess, analyze, and try to optimize their costs. Trading is no different.
So this lesson is about our costs as traders?
Yes, we will look at the direct costs that traders need to account for. The biggest one is normally overlooked.
Go on then, what is it?
Remember when we introduced the bid-offer spread in the last lesson?
I do.
Well, that's it. The bid-offer spread is normally the largest cost to a trader.
The spread is the difference between the two prices, isn't it? How is that a cost?
Let's do a simple experiment. Let's say I wanted to place a spread bet for £10 per point on the UK 100. Let's pause the ticket so I can explain. I can sell at 74.85.1 and I can buy at 74.85.9. Can you see that?
Yes, that's what the broker is quoting.
Right. I'll buy at 74.85.9 and instantly close the trade. If I'm long, this means selling back at 74.85.1. If I'm betting £10 per point, this means I've purchased a notional value of £74,859 and immediately sold back a notional value of £74,851, a difference of £8. So I'm £8 worse off. The market hasn't moved against me, I haven't had a fee taken from my account, but I have £8 less in my account after doing that trade.
So where has that money gone?
Well, the money has gone to the market. This is called the total spread. And as a trader, you need to think of this as a charge that the market, or to be more precise, your broker, has levied on you to place the trade. There is no getting around this charge, and if you trade, all brokers will quote a sell price below the buy price. Now, if you find one that doesn't do that, please let me know.
So why is the market charging me spread?
Well, because it costs the brokers and the wholesale markets supplying them to provide traders with the tools they need to trade. These businesses are there to make a return. Another way to calculate the total spread you are paying to the market is to subtract the sell price from the buy price and then multiply it by the volume, or in this case your stake. £10 times 0.8 equals £8.
Okay, that makes sense. What if the market moves in my favour?
Well, the spread is still there, and it doesn't matter if the market goes for or against you. In my example, you will always pay £8 in total spread. Let's fast forward a bit. Here it's 0.8. And here it's 0.8 spread again. Once you completed this module and you have your practice account, you can test this out. You will notice that you will always pay a spread.
So, if I've understood this correctly, we should be trying to trade at the lowest spread?
All things being equal, yes, but not all things are equal. If you start to think of spread as the way a broker charges you to trade, then you will soon draw parallels with other products that you buy. For example, you probably don't always buy the cheapest car or go for the cheapest holiday. Trading is no different. It's a balancing act. You are looking for value.
When you say value, you mean weighing up what you get against what you pay, is that right?
That's it, exactly. After we've finished with this module, you will start to understand both sides of this trade-off. Excuse the pun. One of the big considerations in the what you are getting column is whether the broker is offering fixed or variable spreads.
Oh, you've lost me. What's the difference between a variable and a fixed spread?
This is fairly advanced, so don't worry if you don't understand all of it right now. You can always come back to it.
Try me.
Okay, first of all, this only applies to index, commodity, bonds and FX markets. In individual equity markets, when trading on company shares, spreads cannot be fixed by the broker.
Okay.
A fixed spread is when the broker fixes the distance between the bid and offer price on a particular market. This is what we saw in the last deal ticket. The spread of 0.8 on UK 100 didn't change no matter where the market went. There are caveats to this, such as time of the day, but for the most part, the distance between the two prices, or spread, is always fixed. This isn't the case with variable spread offerings. With variable spreads, the broker can change the distance between the bid and offer price as they see fit, second by second.
Why would the difference between the two prices change? Why would the spread change?
Well, for many reasons. It's driven by how certain the market is about the price it's offering. If something spooks the market, adding uncertainty, then this is reflected in the widening of the spread. This can be absolutely anything: a monetary policy announcement, elections, even the time of the day.
Okay, but why are these factors important?
Well, before I buy anything, I like to know what it costs. So, if you are trading on a fixed spread basis, you can be confident that you know the cost of exiting a position before you place the opening trade. With variable spreads, you don't.
So what does this mean for my trading?
Well, it's all down to personal preferences, but as a new trader, you should consider going down the fixed spread route. It's one less variable to worry about, and a good way to manage one of the key risks we are going to be talking about in the next module.
Okay, so we've looked at spread, including why it's a cost and how to calculate it. In this next video, we're going to look at another cost, overnight funding. Philip, what is it?
Well, when you trade on margin, you are effectively borrowing from the broker to fund a large portion of your trade.
Yes, I remember you explaining this. When we margin trade, we use leverage. And you've mentioned before that there's a charge for this. Is that overnight funding?
Well, it's part of it. Overnight funding is a fee you pay for leverage from the broker when you trade daily funded bets or cash CFDs. It's also a charge to roll the trade over to the next day. There is no overnight funding charge for trades on futures because the cost to fund these is already factored in by way of a larger spread.
Okay. Can you remind me what daily funded bets are again?
Sure. They are short-term daily bets that roll over automatically. They are priced using the cash or spot market.
Oh yes, the spot market assumes immediate delivery. You've mentioned that before. How is the funding charge calculated?
It gets charged every night as a percentage of the size of your open positions. Do you remember me talking about notional trade size?
Vaguely. Can you remind me again?
The notional is the total value of the underlying instrument you are trading. In my UK 100 example, where we've placed a £10 8-point trade, the notional trade size is £74,859. This is the total unleveraged amount of the trade. It's a bit different for currencies, but for now, let's just concentrate on this index trade.
Okay, so the overnight funding charge is a percentage of this, right?
Yes, you only pay funding on the positions you have open at that moment in time.
Right, and when is that moment exactly?
Well, it varies from broker to broker, but it's normally 10 p.m. every night.
Do I get charged overnight funding if I've traded during the day?
No, only if you have open positions at the time.
And what percentage is the charge?
Let's take a look at our UK 100 example again. The percentage charged is normally about 2 2.5% plus LIBOR, which is about 0.25% in the UK at the moment.
What is LIBOR?
LIBOR is a benchmark interest rate. It stands for London Interbank Offer Rate. It's very similar to the base rate of a country, as we mentioned before. It's the interest rate that the banks lend to each other. Everyone uses it and it's readily available to check.
Right, okay, I understand.
So, if I got a notional value exposure of £74,859, then the overnight funding charge would be £74,859 times 2.75%, which is £2,058.62. Remember, the 2.75% is an annualized rate, so the broker divides the annual charge by 365 days to our daily charge. So for our UK 100 spread bet, if we had it open overnight, we would get charged £5.64p.
What about weekends and bank holidays?
Well, when markets are closed, you are charged overnight funding rate based on the previous working day's positions at that moment in time. So, if we had our UK 100 trade open on Friday at 10 p.m, we would be charged 3 funding days.
Okay, but can't we just close our trade every night before 10 p.m. and open it after?
Well, you can, but remember, this costs you in spread, and there is a chance that you will miss a big price move by doing this. This example is for long positions. Overnight funding is different if we sell and go short.
And how does it work if we're short?
Well, if we borrow money when we are long, then when we are short, we do the opposite. You are in effect lending money to the broker. Just so I am completely clear, you don't actually lend money to your broker because you're only trading a derivative which mirrors what goes on in the underlying cash market.
Wait, so does this mean that we receive something?
Yes, sometimes, but not so much in today's interest rate environment. When you are short, you pay the 2.5% borrowing charge and then you receive LIBOR, which would be a net annualized charge of 2.25% in my example. Because the base rate and therefore LIBOR is so low at the moment, it would mean that you still pay a net fee to the broker. If LIBOR increased and it was above 2.5%, then you would start to receive overnight funding into your account if you were short. This used to happen years ago.
Okay, so that makes sense. Earlier you said that overnight funding on currencies was different. How so?
When you trade currencies, you are swapping one currency for another. If you are doing this via a derivative spread bet or CFD trade, then it's essentially the same thing. This is also reflected in the overnight funding charge.
Okay, why is this?
Well, if you have a currency position, you're always long on one currency and short on the other. When it comes to overnight funding, a trader pays the LIBOR rate on the currency in which they are long and receives the LIBOR rate on the currency in which they are short. These two rates combined and netted off are called tomorrow next rate, or TOM next for short, when the broker adds the 2.5% funding charge.
I think I see what you're saying, but I may need to come back to this. It's quite a lot to get my head around.
I agree. Revisit this later if you like. At this early stage, please just be aware of the charge and why it's levied. In my experience, for an average trader, overnight funding ends up being quite a bit smaller than total spread, but there are scenarios where this might not be the case. Welcome back. We are going to wrap up this lesson by reviewing the other costs you might incur when trading.
We've covered 2 so far, spread and overnight funding. I presume these are the largest ones?
Yes, if you are spread betting, they are likely to be the largest ones. Commission is normally charged on CFDs and margin forex trades. It's not charged on spread bets. Commission is just a fee for placing a trade. It's normally volume based. For example, it may be 0.1% of the notional value, which is typically charged on both of your opening and closing legs. You'll be able to speak to your broker or look up what the commission fee is before you trade.
Why don't brokers charge for spread bets?
It's just a convention. The handling costs are reflected in the spread.
Okay, that's a fairly simple notion. Are there any more we should be aware of?
Yes, money transfer fees can also add up.
Money transfer fees? What are those?
In order to trade, you need to deposit some money to act as a margin with your broker. You also need to withdraw funds from time to time. When you send money to your broker, you can do it in a number of ways. The most popular and easiest way is by credit or debit card. But this can be expensive. When a broker accepts this type of payment, it costs them money. Visa or MasterCard don't provide these services for free. Depending on where you're from, those card fees are normally passed on to the trader, which is around 2 to 3% of the total transaction. Some brokers don't charge for this, and in some countries, brokers aren't even allowed to pass on the fee.
How do we keep these fees down?
Well, the fees are incurred when traders deposit and withdraw using expensive methods like by credit card, for example. If you want to use this method and minimize the cost, you should minimize the frequency of deposits and withdrawals. Alternatively, you might want to use a method that doesn't cost, like a standard BACS, bank transfer.
Okay, that seems sensible.
Sometimes you get charged account fees by your broker. These might be called an inactivity fee or even an account opening fee. Personally, I think brokers that charge these are a bit cheeky and you should challenge them if they are ever levied on you.
Right, I will. Any other charges we should be aware of?
There are a few fairly minor ones you should be aware of before we move on. You might be charged a monthly fee if you spread bet or trade CFDs on company shares. Some brokers passed on the cost that the exchanges charge them for using their pricing data. This can normally be waived if you trade often with the broker. Once you decided on your setup, you might subscribe to a supplementary analysis offering or invest in trading education like My Trading Skills. The last fee I want to cover is for setting up guaranteed stops. We haven't talked about these yet, but we will do later. For now, just be aware that there is a fee for using them.
Okay, that's good to know.
That pretty much wraps up my explanation of the costs that traders might incur. Shall we summarize the lesson?
If you treat trading like a business, you'll need to have a grasp of the costs. In this lesson, we've taken you through the most likely ones. Most of them are linked to volume in some way.
Spread is likely to be your biggest cost as a trader. This is the difference between the bid and offer price multiplied by the volume you trade.
You can trade on either a fixed or variable spread basis. There are pros and cons for each.
If we trade daily funded bets or cash CFDs, we'll need to pay an overnight funding charge. This is a charge for using margin to trade, and it's calculated at 10 p.m. each night on open positions.
On long trades, we pay the charge and LIBOR, or short trades, we pay the charge and receive LIBOR.
Traders aren't charged commission on spread bets, but they are on CFDs and margined forex. This is normally a function of the size of your trade.
Finally, we looked at a few other costs, including charges for depositing and withdrawing funds, account fees, subscribing to supplemental analysis, data fees on shares, and guaranteed stops.
Well done! You should now all be aware of the costs incurred by traders. This will hopefully help you manage them. For an active trader, spread will typically be the largest one, so I would keep a close eye on it and remember it always costs something to trade. In our next lesson, we are going to look at brokers and the services that they provide.